Okay, so in this video, you'll learn how to trade one of my favorite chart patterns, right? It's called the ascending triangle pattern. So let me explain to you, what this pattern is all about and why I love this pattern so much. Number one, right? An ascending triangle is pretty much where you see higher lows into resistance. And a descending triangle is the opposite of an ascending triangle. It's where you see lower highs into support. So visually, it looks something like this, right? An ascending triangle. Okay, this is resistance, and you see the price making higher lows into resistance. Right, you can see higher lows coming into resistance. So this is a ascending triangle because you can actually connect the lows over here and it looks something like an ascending triangle. And on the other hand, right, the descending triangle is simply the opposite, right? You see lower highs coming in, lower highs coming into support. Okay, so this is an area of support, this portion over here, and you can see these lower highs coming into support, right? So this is what an ascending and descending triangle looks like. Now, the thing to note is that the longer the pattern takes to form, the more significant it is, right? And I'll explain why. But first, right, why does this pattern work? And the reason is simple. It's because stop losses gets triggered. I'll explain. If you look at an ascending triangle, right? Let's redraw this, right? An ascending triangle. Okay. Ask yourself, right? Whenever the price hits resistance, will there be traders looking to short the market? You can be sure there is, right? Because, if you study, technical textbooks, you study, trading courses, the internet, they tell you, when price comes to resistance, you should be short the market. And I do agree, but only in certain conditions. And if conditions like this, you see the market testing resistance, for the third time, the fourth time, right? You don't really want to be short this market anymore. Why is that? Two things. Number one, there are a cluster of stop loss, right, that will get accumulated over time just above this area of resistance, right, over here. Let me change the color. Let's change this to red, right? There will be cluster of stop loss, right, that will be built up above this resistance over time, right? There will be stop loss. Why? Because traders are looking to short this market. So when there is enough stop loss that has been accumulated above resistance, there's a good chance that the market will break out and trigger those stop loss to consume this liquidity. Okay, so that's the first reason. The second reason is this. Is number two, right? The first one is stop loss. Number two is that it's a sign of strength, right? When you see the market making higher lows into resistance, what does it tell you? It tells you that the buyers are in control. Because if they are not in control, they couldn't have possibly, made higher lows into resistance, right? They should make something like, come in, get sell down, come in, get sell down, and not, higher lows into resistance that you see over here. So number two is what I call, let's call it strength, right? A sign of strength. So these two reasons, right, tells you, why ascending triangle, pretty much works in the long run, right? Because there are cluster of stop loss above it, and it's a sign of strength when you see this pattern. Okay, so this is why ascending and descending triangle pattern work. And it's also a good lesson to you that if you see the market testing resistance, a number of times within a short period, right, you don't really want to be short resistance anymore because there's a good chance the market will break out higher. Okay, so that's why this pattern work. So now, how do you trade ascending and descending triangle? That's the question, right? So for me, a very simple general rule is this. You look for an ascending triangle in an uptrend, and you look for a descending triangle in a downtrend. So basically, you long ascending triangle in an uptrend, and you short descending triangle in a downtrend. So let me share with you with a few examples. So this one over here, right? Can you see this? Can you spot this ascending triangle? If you can't, right, let me help you with it. It's pretty much simple. It's actually this over here. You can see this area of resistance, and you have this higher lows coming into resistance. I mean, oh my goodness, how did I draw that floating circle, right? This is resistance, and this is the higher lows coming into resistance. So can you imagine the thought process of a trader who are, unaware of reading price action limiting? Oh, look at this, right? Price is at resistance. I should be short. Right, so they go short. And where would they put their stop loss? Well, the textbook says, right, put your stop loss just above this high over here. So they put their stop loss just above this high. And then, right, with enough traders, shorting the market, there is, a cluster of stop loss built up above this area of resistance, right? And Number two, right? This is a sign of strength, right? You can see lower highs coming into resistance. This tells you that buyers are willing to buy at these higher prices. And number three, right? The market breaks out higher. Okay, and on top of it, right? Number three, you have those momentum traders piling into the trade, longing on the breakout. So imagine, right, the order flow that is in your favor. Number one, stop loss getting triggered, right? This becomes a buy order, because if you are short and your stops get hit, what does the trade? What is the order of the trade that gets you out of the trade? I mean, that may sound confused, but basically, what I'm saying is that if you are short and your stop loss get hit, right? Your stop loss is basically a buy order to get you out of the market. That's one. Number two, traders who want to trade breakout, when they see the market breaking above the highs, they would also go long. So you have these two group of traders going long, which actually, create a huge demand for higher prices, right? A huge buying pressure that is likely to push price higher. So in this case, right, you can see that the market did trade higher. Okay, and now I want to walk you through, right, how you can go about setting your stop loss, entries, and exits. So there are a few ways to do it. There's really no best way, no perfect way, but for entries, it's very simple. You can either look to go long on the break of the highs, or you can look to get long, right, when the market breaks and close at this level over here. So there's really no right or wrong to this. As for stop loss, right, I typically recommend looking at the nearest structure low, nearest swing low, which is this one over here, and give it some buffer and set it, some buffer below it, right? You can use an indicator like the average true range, set it 1 ATR below it, right? Just basically you want to give it some buffer from the lows. Why do you want to give some buffer? Is because you don't want the market, to come down, spike you out, and then continue trading higher. So give it some buffer, right? Give your stops more room to breathe, to say. And on top of it, right, the reason why you want to put it down there is because if you know how a ascending triangle pattern looks like, it looks something like this, right? So if the market breaks and closes below this so-called upward trend line, chances are this pattern is invalidated and you don't want to stay in this trade any longer. Okay, so this is how you can go about with your entries and your stop loss. Now, what about your take profit, right? Again, there are two ways you can go about it. For take profit, the first thing that you can do if you want to have a fixed target, right? For this, you can actually measure the move from here, this high to this low, right? So let's say, for example, let's put it as, say, 100 pips, right? So what you can do is that you can project this 100 pips, right, from this breakout level, from the breakout level at resistance, you go up another 100 pips, right? And over here will be your take profit level. So you basically copy this portion over here, the distance that the price has moved, and you then paste up above here. So if this has moved 100 pips and the market has moved up another 100 pips from the breakout level, all right, another 100 pips, then this level over here is basically your take profit level, right? That's one way you can go about in exiting your winning trade. An alternative approach, right, that you can do if you want to trail your stops, trail your winners, you can use a moving average, right? So for example, you can use a 20 period moving average. Oops, sorry, this is the 50. The 20 period moving average, this red line over here, and you can trail your trade, right, as the market trades higher, and you only exit if it closes below it. So in this instance, right, you can see that the market has actually closed below the 20 MA over here, and you would exit this trade. So again, whether you want to use 20 or 50, it's there's no right or wrong. 20 would keep you in with the shorter term trend. The 50 will keep you in with the medium term trend. So it really depends, right, on how long or how short of a trend that you wanna ride. Okay, so this is one example. So here's another example. Can you spot the ascending triangle pattern? Right, give you 5 seconds. 1, 2, 3, 4, 5. Okay. This one over here, this resistance, and then you have higher lows coming into this resistance, right? Higher lows. Again, why does this work, right? If you skip to this portion of the video, you don't know why this pattern works, you can refer back to the early portion and check it out. So anyway, this pattern in this case, right, you can see that this market pretty much is a losing trade, right? You can see that this market basically got you into the trade. You long the breakout and it pretty much collapsed, after which you got stopped out, right? And I the reason why I share with you winning and losing trades, because I want to paint to you the real reality of trading, right? Nothing I share on my YouTube, my blog, website, or anything is 100%. It's all dealing with probabilities, right? So always manage your expectations that there will be winners and there will be losers. And finally, another example I want to share, right? This time, this is the opposite. It's a descending triangle in a downtrend. Can you spot it? I will give you 5 seconds. 1 to 5. Okay, it's actually here. Right, this is the highs, lower highs, coming into support. Okay, so again, how could you have traded this pattern? You can look to place a sell stop order just below the lows, right? Or wait for the market to break and close below this support before you get short. Again, right, stop loss, you want to reference from the nearest swing high. So which is this, give it some buffer somewhere about here, right? Your stop loss should be somewhere about here, because if the market can break and close above this downward trend line, chances are this pattern is invalidated and you don't want to stay in the trade any longer. Now, the third question is, where do you set your target, right? Again, I mentioned that there are two ways. Number one, take the distance from this high to this low. This is a classical charting principles. So if let's say the distance here is say 500 pips, for example, just project down 500 pips from this support and your target will be somewhere here, right? So in this case, you may or may not get filled on your target. I think possibly not, about 80% there before the market reverse higher. Okay, so and the other second approach to trail your stop loss, as I mentioned, is to use a moving average like the 20 or the 50, whichever, depending on the type of trend that you want to capture. So in this case, right, you would have probably exit this trade somewhere here. Okay, so this pattern, right, if you let your winners run, right, there will be winners, I mean small winners, small losses, right, but there will be a few times, right, possibly 1 in 10 trades where you catch a big move where the market just keep trending over a long period of time, and that's where this chart pattern could really yield you some really nice risk to reward on your trades. Okay, so this is the ascending and descending triangle pattern for you. So let's do a quick recap. Okay, so an ascending triangle is basically higher lows into resistance, and the descending triangle is lower highs into support. The reason why this pattern works is because there is order flow at the other end of the market structure, right? Like, say for example, ascending triangle, there is just traders putting their stops above resistance, and if the market hits those stops, right, the stops will get triggered, and on top of it, you have breakout traders looking to get long. These two group of traders will create huge buying pressure that leads to higher prices, right? If you want to trade this pattern, trade with the trend for better odds, right? After all, the trend is your friend. And then we discuss about entries, stops, and exits, right? How to enter the trade, where to put your stop loss. Okay, let's do a quick recap because I think this one is important for most of you. So entries, I mentioned that it's quite straightforward. You can either look to long on the break of the highs, or you can wait for a close after the market breaks out of resistance. For stop loss, right, I typically reference from the nearest swing low and give it some buffer, set it slightly below it over here, because you want to exit your trade when this pattern is invalidated. So when is this pattern invalidated? It's when this upward trend line, right, gets broken. So the pattern is invalidated. As for exits, I mentioned that you can use number one, right, price projection. Let's call it PP, right, price projection, using if calculate the distance from the highs to the lows, right, and then project it up from your entry price, and this is where you could consider taking your profits, right, your target profit. And the other technique I share with you is you can use moving average like the 20 or the 50 to trail it using a moving average. Okay, so with that said, if you've enjoyed, right, this video so far, what I recommend you to do right now is to go down to my website, tradingwithrainer.com. I'll put the link below, but for those of you who want to know what's the link, it's over here, tradingwithrainer.com, and I'll put it below this video as well. And then scroll down, right, to this portion here, and you'll see 2 trading guides. Go and download them, right, because it will complement whatever you have just learned today, right? The ultimate guide to trend following and the ultimate guide to price action trading, right? It's completely free, so just go and download them, right? And you'll pretty much, get a clearer picture to how I trade the markets. For the price action guide, you'll learn how to better time your entries and exits, right? And learn how to read the price action of the market, what the market is telling you. For the trend following guide, you'll learn how to write massive trends in the market, right? So you can write, uptrend and downtrend, and even, when the market or the stock market is in a recession. So completely free, right? I'll suggest you go down and download these 2 trading guides, and I'll send it to your email. So with that said, I wish you good luck and good trading, right? If you've enjoyed this video, please hit the like button, right? Subscribe to this channel as well, so you'll always be updated. And any questions for me, just let me know below and I'll get back to you. So with that said, I'll talk to you soon.